So good afternoon, everyone. We'll continue our discussion on portfolio optimization. From your other fin subjects, you know that investments is a very important aspect of financial management. In investments, we learn about the Markowitz principle about risk and return. That the layman's term suggests that we don't put all our eggs in one basket, that we have to diversify. It's a foolhardy proposition to just put your investment in Jollibee. Kung dun lang napaka-risky nun class kasi if Jollibee falls, then all your investment might be wiped away. So it's very important to create a portfolio. Okay, so what have you learned in your prior subjects as regards portfolio? Okay, you can easily compute for the return of a portfolio. Return of a portfolio is equal to the sum of your individual returns multiplied by the weight. The weight is simply obtained by getting the proportion of your asset that's invested in the total portfolio. And we also learned that the risk of the portfolio, we have learned this in the past, that it's actually your double summation, okay? Wi, Wj, covariance of Ij. I from 1 up to n, j ranging from 1 up to n. Okay, so this one is pretty straightforward. This one, we said, requires more involved computation. However, when we use R, the involved computation actually is not a problem because R will automatically compute that for us. Okay. So I'm looking for sending. I can't find the edit, the annotate function. Anyway, so let's have a quick review of what we have discussed so far. We have learned how to download stock prices using quant mode. Okay, we have also learned how to calculate the returns of assets, either using quant mode or performance analytics. Okay, so let me, where did we stop last time? Okay, we learned how to install packages that are relevant for computing returns. We use the dev tools and also in particular the QMAO package. This is very important. So I hope you have already QMAO package. Kindly check, please. If you have it, you can check here. Packages and then QMAO. All right, you should have already QMAO and then click that. Make sure that it's loaded. And please chat if you have that already. Okay, good. Thank you. All right, there's another thing that I want. Okay, I also discovered that in order to make full use of QMAO, you have to install this package, financial instrument. So let me just share that with you. Kindly install this class. financial instrument. And once you have done that, please chat if you're okay. Okay, thank you. How about the others, please? By the way, class, on Sunday, we'll have our online session. Attendance is not to be checked, but it's a combined class for FINLYTS 1 and K31, K32. I'll be recording the session. We'll be starting with the machine learning discussion, and we won't be able to cover everything here. So whatever I'm not able to cover, I'm going to post the remaining part. In the other section, we reached up to code number 500 something. So there were only a few more lines of code which we were not able to run. Okay, so thank you. All right. So what we did last time was we created an object called tickers, and tickers consist of these objects: Apple, Google, etc. Then we defined the start date up to the end date, daily data. Okay. When we run this class, you'll be able to create these objects, XS objects of Apple, here, Amazon, Google, GSPC, etc. Okay, we did that last time. Okay, and then what we want is actually not the prices itself, okay, but the returns of the prices. So we can make use of the PF function or the make price frame. The QMAO package will allow us to draw out the adjusted prices from a set from your different XTS object. So here I'm creating this object PF from the quant mode, from the QMAO quant mode add-on. Okay, that's what that means, quant mode add-on. And we're using the make price frame. So what will happen is that it will draw out the adjusted prices from each of the objects and then generate an XTS object. So if I run this, so we now have this PF object. Let me close this. Okay, this PF object. So you have the stocks, Apple, Google. These are all adjusted prices. Okay. Aside from the make price frame, you can make use of the PF function. The same thing. Okay. I won't run this anymore. You'll get the same value. All right. Or you can go directly and get the returns, the log returns or the discrete returns, depending on what you want. Here, I'm using the make return frame as distinguished from the make price frame a while ago. Okay, sorry, did I share this with you last time, class? Kindly chat, please. Okay, so I have shared this with you. Okay. All right. Also this one, the make price frame. So this is supposed to generate one object, an XTS object, with the adjusted prices of your stocks coming from your tickers. Okay, preferred is equal to adjusted, and a.omit is equal to true, silent is equal to true. So we identified the dates. Okay, so another way to do this is use the PF function. So we now have this object PF. It's an XTS object. It's an XTS object. All right, then you can also automatically create an object consisting of the returns. So here, we're using make return frame. Now, did I share this with you last time, class? Okay. All right. So we're creating this object RF, and the function that we're using is make return frame. So it's the returns coming from this objects from, we specify the date up to, and then we want the adjusted prices. Okay, the type of returns is continuous. If you want a simple return, you use the discrete returns. Okay, so you can now create this object RF. So here, okay, there. It will give us now the log returns of your assets. And then we'll just remove the missing value on the first row. And take note, this is an XTS object, the RF. Okay, so we remove the first row because it's a missing value. Okay, there. Okay, any questions so far? Kindly chat, please, if you have reached up to this point. Okay, good. All right, so let's continue, class. Now we have an object consisting of the returns of your assets. Okay, now we begin our discussion on portfolio returns. As I said a while ago, univariate returns are computed by getting the log of your price at time t divided by the price at time t minus 1. So you get your individual returns of your asset. Now, if you have a portfolio, let's say a portfolio of 2 assets, how do we compute for the returns? As I mentioned a while ago, you should have the weight of each of the portfolio, and then you should have the returns. We have the returns already. Taking a look at this one, RF. You have the returns of each asset. Now we will just have to identify the weights of each asset so that we can now compute for the portfolio returns. In this case, the portfolio returns will be equal to the weight of Apple times the return of Apple, the weight of Google, the return of Google, etc. So you'll have daily portfolio returns. Okay, you'll have daily portfolio returns. Okay, all right, then okay, how about this? Do you have this already? Portfolio returns. Class, do you have that part of your notes? None. Okay. So let me share. I'll share some of the notes here. Okay, but for the rest, you're going to have to write them yourself, especially the codes. Okay. So let me share first some of the notes here. If we want to calculate the returns of a portfolio, of course, we can do it manually, but of course, what sense does it give us, or what benefit does it give us if we are going to compute manually? If we can make use of functions in R that will allow us to compute for the returns of a portfolio. So we're going to make use of the return that portfolio function. So let's start with a portfolio of two assets. Let's just subset our object, our RF object. Here is our RF object, and let's let's have this portfolio consisting only of Apple and Google. All right. So let's create this object port one. Okay. So kindly just write this. This is coming from your RF object, and we're just subsetting the first two columns. And if we run this, all right. So this is now our port one object, portfolio one object consisting of Apple and Google and their returns. Okay, 1257 observations. RF is also 1257 observations. Okay, we're not changing the number of rows of observations. We're just limiting this to the first two columns. Okay, Apple and Google. All right. So any questions so far, class? Kindly chat, please, if you have it. All right. Thank you. Now, you know, class, that the portfolio, in order to generate a portfolio, you have to know the weights of the assets. Okay, so let's assume first that there's a 50-50 share between Apple and Google. Okay, and then, so let's generate an object called port1ret. So this is the return of your portfolio. A while ago, we have portret, which is Apple and Google. But this time, we're going to get the portfolio returns. So we're going to make use of the performance analytics package, and then we're going to use the return that portfolio. Okay, the object that we're using is, okay, this is our object, port one. If you recall, this is port one. Okay, Apple and Google, the returns. And then we have to identify the weights. Okay, so here we're using, let's assume that it's 50-50. Okay, and then let's view this. And then let's change the column name of our object, which is port1ret, into port50ret. It's just an arbitrary name. I just wanted to show you this is 50-50 and then ret. And then let's compute for the return of the portfolio, okay, annual return. Okay, because what we're going to get are daily returns. Okay, if you average that, all the daily returns, what you'll be getting is the average daily returns. What we want is the average period return for the whole period from 2017 to 2021. All right, so could you kindly run this? Kindly chat, please, if you're done. Okay, let's give a few more seconds to your classmates. Okay, when you're done, please chat so that I know when to continue. Waiting for the others, class, to confirm that they got this. Okay, waiting for the others, class. Okay. All right. So if you run this class and let's view it, you'll be able to generate this object here, portfolio.returns. So you notice now it's only one. Okay, it's only one column. Why is it only one column? Because we computed for the, I'll open this portrait, this one. Okay. So let me just get the, okay, head, port one. Okay, so we have this Apple and Google. Now we said that if you are going to compute for the returns of Apple and Google, so because the data is daily, then the returns will be daily also. So let's copy this, Control C. Okay, and then I'm going to create this object, ret, and it's equal to 0.5 times this one plus 0.5 times. Okay, so I'm getting the weighted return, right? So 50% of the return of Apple plus 50% of the return of Google. So will this, and then ret, we print ret. All right, 764895. So is it the same as this? 767674895. Okay, so just a few rounding off differences. But we were able to show that indeed the first portfolio return is just the sum of 50% of the return of Apple and 50% of the return of Google. Okay, is that clear so far, class? Portfolio 1 code again. Wait, may tanong dito si ano. Portfolio 1 code. Which one? Which one? Which one? Portfolio 1 code. Are you referring to this? This one? Okay. Okay, when you're done, Alvi, please chat. Portfolio 1 object, port 1 is supposed to be an XTS object consisting of the returns of Apple and Google. Okay. All right. So let's move on here. Okay. So we were able to show that indeed the return for day one of your portfolio okay here portfolio one return here. So this consists of the 50% of the Apple return and 50% of the Amazon return. Why is that so? Because Google pala, sorry, Apple and Google. Because we have defined our portfolio to be 50-50, 50% weight for equally balanced siya. Okay, and then let's just I'll just replace this with the name port 50 ret. So column names of my portfolio one object, I'll just replace it by port to indicate that this portfolio 50-50 returns. Okay, of course you can name it otherwise. And then this one, this one class, these returns are daily. If you get the average of this, then you'll get average daily returns. If you want to get the annualized return, then you have to multiply it by 252. 252 is the average number of trading days in a year. Okay. All right. So let's run this. This gives us the annualized return. Okay, this one. So the annual annual average return for your portfolio is 32%. Okay. So let me pause for a while and ask you for your feedback if you were able to follow along. Did you get 32% for your average annual returns for your portfolio of Apple and Google? 50-50%. 50% Apple, 50% Google. Is it possible to be able to generate a higher returns, class? What do you think? Is it possible to generate a higher returns than annualized return than 32%? Is it possible to have that? Answer, please. Possible ba yung class? Is it possible to have a portfolio returns greater than 32%? The answer is, the answer, class, is yes, of course, it's possible. How can you do that? Then vary the weights. Okay, maybe you should load more to the stock that's earning more. Okay, so it's possible. Here, the weight is just 50-50. So if all throughout your period, 2017 up to 2021, you still maintain a 50-50 portfolio weighing weights, then your average return is 32%. All right. Now, could you please tell me if you have, did you discuss the concept of rebalancing in your previous fin subject? Kindly chat, please. Did you in any of your subjects in fin discuss the concept of rebalancing? Answer, please. I just want to know so that I'll be guided on how to discuss this. All right. Thank you. Let's see. Okay, no. Okay, good. So that means that I'll have to discuss it in a bit of a greater detail. So let me first share with you the notes first. Okay, Control C. I can't copy long lines of notes. Okay. So I shared with you here a site. This is from Investopedia. I like how Investopedia discusses it because it's quite simple. So let's open that, class. Investopedia here. All right. So let's learn the concept, the basic concept of rebalancing. Okay, when does rebalancing happen? And what's the purpose for rebalancing? Okay. So let's do some key takeaways here. When you say rebalancing a portfolio, it means that you're changing the weights of your assets in your investment portfolio. Okay, in the first, in what we did a while ago, we were assuming that the weight is 50-50 from the start up to the finish. Okay, there's a reason why you might consider rebalancing. You might consider changing the current weights of your asset. Now, what do we mean by to rebalance? What you do is either to sell your stocks or buy stocks so that you'll be brought to your desired portfolio composition. Now, why is that? Take note that the market value of your asset changes across time. So for assets that tend to have positive returns, that means their prices are going up. Okay, what happens? What happens with that? Okay, what happens is that the value of your asset of that, let's say Apple in our case. So if Apple prices have been increasing over time, that means positive returns. That means the weight of your Apple, the value of your Apple increases over time. So when it increases, let's say in larger proportion relative to your Google, what will happen is that your portfolio will have a change as far as weighting is concerned. Perhaps Apple will have now, let's say, 60%, and Google will now have 40%. Okay, so it destroys your original portfolio intent. Okay, now what's the rationale for maintaining a particular balance, particular weight? So, for example, you might wish that Apple should be from 40 to 60. Okay, and then also, let's say Google can be maybe also 40 to 60. All right. So how do you do that? How do you maintain your, let's say, your preferred uh, preferred balance as far as your portfolio weights, portfolio asset weights is concerned? Then you'll have to do some buying or selling. So as it states here in Investopedia, as the values of your assets change, the original asset mix will change. Of course, naturally, the mix will now change. So what will happen is that this can cause increased amount of risk in your net profile. Okay, so rebalancing is needed because it will allow you to go back to your original portfolio weight. Okay, but there are of course drawbacks to this one, because if you're rebalancing, it will cost you, because you're buying and selling. So there are transaction costs, there are tax costs. Okay, so that's why people do not generally do daily rebalancing or weekly rebalancing. What's most common is annual rebalancing or semi-annual rebalancing. Sometimes people do monthly rebalancing. And the reason for that is they would want to have frequently check their portfolio weights, but that's a relatively more expensive proposition, because every time you rebalance, every time you check your portfolio weights, every time you draw down, every time you change or sell your assets, okay, there will be costs involved there. Okay. How often, class? How often? Well, it depends on the risk appetite of the individual. Okay, so it depends on the risk tolerance. So some would rebalance once a year, some would rebalance every other 6 months. Okay, so I leave you guys to read the concept behind rebalancing. So this is just a very simple example. Initially, you have a bond fund, okay, equity fund 40%, treasury fund 10%. This is how your portfolio is weighed. Now, after some time, there was an increase in the weight of your assets, of your equity. So it's now 49, 42, and then 9. Treasury fund did not change much, but it was the equity that changed by 9%, or yeah, by 9%, and then your bond fund decreased by around 8%. Okay, so what do you do with that? You can do rebalancing. Okay, so I would want you to read through this. Okay, it gives us an idea how we can do rebalancing, and also the effect if you're not going to rebalance. Okay, there's an impact if you're not going to rebalance, and we're going to show that in a while. So let's go back here, class. All right, so this is all about rebalancing, process of buying and selling portions of your portfolio in order to set up the weight of each asset class back to its original state. Okay, So I hope that's clear, class. Clear ba yung concept ng rebalancing? Kindly chat, please. If the concept of rebalancing is quite clear. Okay, since you have not discussed this in your previous subject, we're going to look at this in this subject. Is it clear, class? Okay, thank you. Thank you for your comments. All right, now let's compare, class. Let's compare, and I'm going to share this maybe up to here, 367, Control C. Okay, I'm going to share with you some of the code chunks because in the interest of time. All right, so here, let's create this object. It's also a portfolio. Portfolio 1 return rebalance. So the original one was port ret, right? Port 1 ret, which is this one. Now let's create something that's now rebalanced. So we're going to make use of the performance analytics function. And then we're going to use the same, return that portfolio, identify the asset, port 1, same thing, weight 0.5, 0.5, but we will have to add rebalance on. So you can rebalance weekly, rebalance monthly, rebalance annually, rebalance every 6 months. For our purposes, for our discussion purposes, let's rebalance by months. Okay. So if we run this and then view this. Okay, what do we now have? We now have a portfolio, okay, an object called portfolio 1 ret rebalance. And you now have this portfolio returns. Let's compare this now with the original data that we got, values that we got, the portfolio 1 ret. Okay, so I'm just going to change the column name port 50 rebalance ret. So this one, port 50 rebalance return. Okay, just changing the column name. All right, up to where did I share with you? Did I share this with you, class? I think so. Control C up to 372. Okay, up to 372. All right, so let's now generate an annualized table of performance of your portfolios. Okay, we will use the Sharpe ratio, which is just the annualized returns compensated for the risk. So you know the formula for Sharpe ratio, class. It's just your return minus the risk-free rate. And let's assume that the risk-free rate is 3%. 3% is the annual risk-free rate. So let's now create an object comparing the putting together side by side the portfolio 1 ret and the portfolio 1 return rebalance. Okay, so let's call it all portfolio 1 ret. So let's column bind portfolio 1 ret and portfolio 1 retain balance, and let's change the name. Okay, so let's run this first. So all your port ret, it's now port 50 ret and port 50 rebalance ret. We can just change the name to column names, non-rebalance, and monthly rebalanced. So let's run this. Okay, so this is now your non-rebalanced returns, and this is your monthly rebalanced returns. Okay, let's compare this, class. If you take note, class, for the first 30 or so days, first month sa January, class, all the returns are the same. January 25, January 26, up to January 31. The returns are the same. Why? Because we haven't rebalanced this. Because, of course, the rebalancing that we ask R to do is monthly. Okay? So, beginning February, this will rebalance. And take note, February 1, okay, this is your non-rebalance. It's 2.9375. For the monthly rebalance, it's 2.89. Okay, so for the first day of February, your non-rebalance was higher than your rebalance, 2.89, 2.93. However, on the second day, your non-rebalance is 8.04, 8.05, while your rebalance is 8.4566. So this is higher. So now you have returns that are different from each other until the end. So they were only the same for the first 30 days for the month of January. Why? Because the rebalancing we specified for R to do is rebalancing every month. Okay, of course, if this was annual, then you have your annual returns that will be common for 2000, let's say 2017, it will be the same, and then it will change in 2018. Okay, did you get that, class? Did you get that? Kindly chat, please. All right, then let's create a table of annualized returns. All right, so all port 1 RET, which consists of your port 1 RET and your port 1 RET rebalance, and then identify natin yung risk-free rate, which is 3%. Then we convert this into daily. 3% divided by 252. Okay, so let's run this. And we have this. Okay. Annualized return. You can see that your annualized return for non-rebalance is less than your monthly rebalance. So there's an advantage to rebalancing. And also the risk of the non-rebalance is higher than your monthly rebalance. In fact, the Sharpe ratio, as I said, which is a measure of your returns less your risk-free rate divided by your risk. The annualized return for your monthly rebalance is higher than your non-rebalanced. Okay, so there's an advantage as far as monthly rebalancing is concerned. Okay, any questions, class? And I don't think I have shared this with you. Okay, just write this, class. Compare performance of the two via plots. Then kindly write the code charts.performance summary. So that's the function that we're using, charts.performance summary. And then the all project one. Okay, then please chat if you got this plot. Okay, only one. Let's wait for the others. All right. Okay, thank you. So we can see here that we were able to generate a plot comparing your non-rebalance, the black one, and your monthly rebalance, the red one. You can see here that there are portions where your monthly not rebalance, non-rebalance is greater. Okay, so in these instances, you can see here, for example, that your black one is above your red one, but towards the end, your red one was higher than your black one, which is your non-rebalanced. For first few months, of course, it should be the same, but come February, there will be a difference. Okay, and then this is your daily returns, and then this is your drawdown. Okay, again, may I ask you, class, if you discussed what are drawdowns in your previous fin subject? Did you discuss that, yung drawdowns, class? Okay, no? All right, sige, thank you. All right, so let me share with you some notes about drawdowns. This is very practical. class? Okay. So let me just share with you some of my notes. Okay, I will not control C, copy long lines because to generate an error. So that one, and then oops, too long. Where did I stop? Till 385. Okay, 385, and then too long again. Okay. So very quickly, class, what's a drawdown? It's related to your portfolio rebalancing. So when you say you're drawing down, okay, note that your drawdown is always negative. So that's a time when you're selling your assets. Okay, remember that when you're rebalancing, you're supposed to be selling your assets. Okay, so drawdown class refers to the process of reducing or selling a portion of your stock holdings in your portfolio so that it will bring back your portfolio weights to your target asset allocation. Okay, and it's supposed to be a risk management strategy that aims to maintain the desired level of diversification. Because as we said, especially in markets where your a particular stock may tend to really appreciate very highly, okay, or very fast, then that could put your portfolio in a risky position because if that happens, then a lot of your assets will now be accounted, a lot of your portfolio will now be accounted for by that highly performing asset. And that's not what you want, because what you want is just a balanced portfolio. You want, you're looking at both the risk and the returns. Okay, so I'll just leave you, class, for you to read this. Here's how it works. This is just an example. Okay, so I would assume that you're going to read this, but the concept is the same. Okay, drawdowns are just selling off your assets. As I said a while ago, that's why here in drawdowns, okay, it does not cover, class. It does not mean, okay, here, it's always below zero, diba? There. So, and it follows the cumulative returns. This is cumulative returns. See how your portfolio cumulative returns go down? Okay, so this one follows that. Okay. All right, so let's go here for portfolio optimization. Okay. So we said that portfolio optimization requires that we are able to come up with a portfolio mix. When you say portfolio mix, the optimal weights of your assets. If you have two assets, then you only have two weights, weight one and weight two. However, if you have more assets, let's say you have 10 assets, Then you'll have to compute for weight 1 up to weight 10. Okay, what is the weight of your asset in order to, you have two objectives, either to minimize your risk or to maximize your portfolio returns. So these are the 6 basic steps in coming up with a portfolio. Okay, number 1 is you have to create the object, your portfolio returns. Okay, so define the portfolio returns and then create a portfolio of returns. Then we will have step 2 and step 3 tells us that you have to add the constraints and add the objective. So we'll discuss this in a while. And then optimize the portfolio, extract the weights and other measures. For the other section a while ago, we were able to reach up to step 4 and step 5. Okay, so for next, in your case, I'm not sure where, I'll also upload the video of the first section. And then if we're not able to cover up to step 5, then I will create a record of up to covering step 4, step 5, and step 6. All right, so this is the, did I share this with you already? In the interest of time, okay, let me share with you up to step 1. Control C. All right. Okay, so let's review the steps that we need to take. Step 0, we define the object. We already have that class. So we're just making use of the Apple and Google portfolio, port 1. This is our port 1, right? That's the returns of Apple and Google. Okay. Okay. So let's take a look at the head, the first 6 values of your port 1. Okay, so this is step 0. Since we already did this a while ago, then we're just checking it, class. For your case, you'll be required more than 5 assets. So you will have to check, class, and make sure that your object in step 0 is indeed a portfolio of returns, a portfolio of assets with return values. Okay, log returns. All right, then number 1, class, is this is just to define the specification. So we're going to make use of the portfolio analytics. Okay, this one, class. And you'll have to also install the library for each. Okay, because sometimes yung portfolio analytics will not run if this is not installed also. So library, portfolio analytics, and then also for each. All right, so make sure you run that. You run it. Okay. And then step 1 is we define the portfolio. So we have the port 1 object, and then I'm creating here an object called portspec1. Now this is a container. Portspec1 is like a container that contains all the parameters for your portfolio optimization. Okay, so we're going to make use of this. So this is coming from your portfolio analytics. Okay, from your portfolio analytics package, you use the portfolio.spec. And then we define, okay, what are we defining? Our assets will be, we're defining it to be the column names of port 1. If you recall, our port 1 consists of Apple and Google. So we're just identifying the name of your assets, Apple and Google. So that comes from column names. Let me check, class. Column names of port 1, Apple, and Google. All right, so just that's the code. And let's see what port spec 1 is. All right, so port spec 1, okay, right, portfolio analytics, portfolio specification. So this is the formula that we were using, portfolio.spec. And it's just identifying the assets that you're using. Number of assets, 2, Apple and Google. Okay, and then if we view what that object is, view, portspec 1, it is a list. No? So ito list siya. So number 1, okay, it has a length of 6. Then assets niya, okay, ang measurement niya, double. Let's click this. Ang asset niya class, dalawa, Apple and Google. And the default is 50-50. No? Kung wala tayong in-specify na default na ilang weight, ang magdi-default siya into 50-50. Okay? Then, nothing else, no? Ito lang naman kasi yung unang-una natin. So we specified what's inside our portfolio, Apple and Google. All right, then let's go next here. Step 2 natin, class, is add the constraints. Did I give this already in step 2? Yeah, I think I gave it, no? Kindly please chat if I gave step 2 already, please. Not yet? Okay. So this first, I noticed that it doesn't, R does not want long, to copy long text. Okay. All right. So this is step 2 class. Now in step 2, we will have to identify the constraints. So what are the examples of the constraints? Number 1 is full investments. When you say full investments, it means that you are telling R that the weights of the assets should be equal to 100%. So weight 1, let's say you have 10 assets, weight 1 plus weight 2. So the summation of your weights of the assets should be 100%. Now, sometimes that can be quite restrictive because this modeling, when we are doing portfolio optimization, it requires a mathematical model optimization. So when you make use of that full investment, it might not generate a feasible solution. Okay, so in order to relax the constraint a bit, we can make use of the weight sum function. In weight sum, we can relax this requirement that the total asset should be 100 into, we can make it minimum of 99% and maximum of 1.01 or 101%. So this means that your that the weights could add up to 99% or it could add up to 101%. Okay, that's perfectly allowed, class. Okay, because as I said, sometimes if we make full use of the full investment, then our portfolio might not have a solution because that's a very restrictive constraint. And then also for box, class. For box is you identify possible minimum and maximum values of your assets. So for example, you can let your Apple be minimum is 30% and maximum at 70%, which means Apple should have a minimum value of weight of 30% and a maximum of 70%. So that's for your box. And also long only, class, as distinguished from short only. For long only, it means that all your weight should be positive. Kasi di ba pag long only, it means that you cannot buy your own. The opposite is short only, which means that you can borrow stocks and put it as part of your portfolio. So long only means that your weight should be positive. So it cannot be a negative weight. Because when you have a portfolio with a negative weight, it means that you're shorting that asset. Okay, you're borrowing that asset. Okay, so let's now, okay, I'm going to share this with you. Okay, so for step 2, Control C. Okay, so let's take a look at our at our step 2 now. Step 2 is, okay, we identify the constraints. Okay, and what we do is we use the first object, portspec 1. Okay, as I said, portspec 1 acts as a container where you put all your requirements. Here, we're using portspec1 and then adding a constraint. So add that constraint. So you notice here, there are 3 lines of codes here. Each one, we're adding a constraint. So the first constraint, if you take a look at this one, the first line here, if you want it to be full investment, then this is how you write that code. Portspec1, add that constraint, portfolio. Our portfolio is our portspec1. Where did you get this portspec1? This is from the step. This is from step 1, right? Here. So we identified first our container. It's like a container, which it's a receptacle for all your codes. All right, portspec1, and then we add this constraint. So I'm not running this, okay, class. I'm just using this type is equal to weight sum. Remember, weight sum allows us to have weights that equal to 0.99% or 100%. This is less restrictive as compared to full investment. So your weight can be 99% total weight, and your weight can be total 101%. Because if you put it at 100% exactly, then, but I want you to try this, no? And see if you'll have a solution with that. Okay, another add constraint is add that constraint. Then we have type. Once again, portfolio is equal to your receptacle, port1, port_spec. And then this is long only, which means that the weight should only be positive. And then this one, add constraint again, same object. So you keep on adding constraints to that object. Portfolio is equal to portspec1. Type is equal to box. So for box class, recall that we are able to determine or to specify what is the minimum weight for each asset. Here it's minimum 0, maximum of 70%. So which means that any asset can take, it cannot take a less than 0 value, but it can take a value that's up to 70%. Okay, so let's run this. All right, and then let's view what happened now to our portspec1. Let's run this. And you will see now that a while ago it was only assets. Now we have here constraints. So we have constraints here. And the constraints are 3 in all. Okay, so let me run this. Let me click this. So what's the first constraint? Okay, you can still click this. First is your weight sum constraint. Okay, it's 99% minimum and 101% maximum. So that was your first constraint. And then you have another constraint here. It's your box constraint. So you have your box constraint here, 2. Okay, so let's run both. Okay. So this is for your long only. It means that your asset can be from 0 to 100%, all positive. However, we have another constraint here for your box, which tells us that your assets can only get values from 0 to 0.7%. So this will overturn this the long only will be overturned by the box, because the long only tells us that it should be positive. So it can be from 0 up to 100%. Okay. But if it's a box, with the box, it tells us that it should only be from 0 up to 70%, which is the requirement of our asset there. Okay, so that's how you generate the constraint. Okay, so let's now go to our objective now. So let me share this with you. Control C. All right. So this is step number 3. So what's step number 3? Step number 3 is identifying the constraints, the objective. For portfolio optimization, there can be 2 objectives. Number 1 is risk minimization. So if you're focusing on trying to come up with a portfolio that minimizes the risk, then this is the objective to use. Or you can create a portfolio where the objective is to maximize the returns. Then this is the objective to use. You use the function type. Okay, type is equal to return for profit maximization or returns maximization, or type is equal to risk for risk minimization. All right. So let's now add. Okay, here I'm creating this object, port min var, portfolio minimum variance. Of course, we can still use this portspec, but I just wanted to create this object so that later on, if we, for example, would want to create a portfolio that maximizes returns, then we will preserve the portspec1 object. Okay, kasi dito class, yung port min var natin, this time, hindi na add constraint to, no? Add that objective. And then our portfolio is port min var 1, which is this one, which is your port spec 1. So that includes your asset. This includes your object, your constraints, di ba? And then we write the objective type is equal to risk and name is equal to standard deviation. Okay? And then let's view our portfolio minimum variance 1. Okay, so let's run everything here. Okay. So, all right, let's take a look at this class. So now, our object port min var, okay, includes with it the not only the assets, not only the constraints. Okay, the constraints tatlo to, di ba? Okay, same thing, but also the objectives. So here the objective is portfolio risk objective. Okay, if I click this, portfolio risk objective, then we know that the type is risk and the name is, the metric is standard deviation. Okay, so we're minimizing the standard deviation. All right, so let's go here. Okay, so we have developed this port min var. All right, then let's now optimize this. Let's now create your portfolio. Okay, so let's now optimize this. I'm going to share this with you. Okay, this will not have to be only first. Control C. Shadow sensitive CR sa ano. Okay, so let me just cut it. So first this one, Control C. So kindly copy this. All right. That one, and then this one, A to C. Let's see if this will fit. Control C, Control V. Okay, it's fitted. And then this one, 4. Okay. Control C, Control V. Control. So here C up to this one. So finicky. Yeah, I think I shared already ROI. Okay. Let me just start from 4 up to 510. Control C. Okay, there. Okay, and then see this one. Okay. All right. So let me go back here. So take note, we have already created an object called view port min var. So how do we optimize now our portfolio? We use the function optimize that portfolio. So what does R do? Okay. I'll leave you class to optimize that portfolio there. So this is coming from your portfolio analytics package. So this function aims to provide a wrapper for constraint optimization of portfolios that specify constraints and objectives. Remember, we mentioned the constraints and we mentioned the objectives. So optimize that portfolio. There are several methods that we can use. So ROI, ROI old, PSO, Gen, SSA, okay? So I gave you some explanations for this. We're not going to really look at all of them because some are more complicated. Okay, where is that? Here. So first we have DE. So this is differential evolution optimization. So I identified the different methods that may be used in portfolio optimization: random, ROI, R optimization infrastructure, then particle swarm optimization. So different methods. For our purposes, we're going to use the random because this is one of the most used. Okay, it makes use of the Monte Carlo simulation. Okay, so let's now optimize our portfolio here. Okay, I'm not sure. Did I give this to you? Did I give this class? Control C. Okay, so let's take a look at this. This is step 4. Okay, step 4A. So this is for risk minimization objective. You can try this for return maximization objective. So we're going to use a set.seed so that we have the same answer because it will make use of Monte Carlo simulation random numbers. So the function is we're still going to use the min var opt1 object and then optimize that portfolio. Okay, the object that we're going to use is R is equal to port1. This is for Google and Apple. Then our portfolio is port min var 1. Okay, and then optimize method is equal to random. All right, so once we run this, it will now generate this object. It will take some time kasi ito na nagmo-Monte Carlo simulation na siya. It generates several weights, okay? And we'll try to compute which one will provide us with the least amount of risk. So it will take some seconds. I forgot to use TikTok. Okay, while it's running, class. So medyo medyo matagal siya ng konti. Not that much kasi nagsa-simulate siya ng different weights, no? All right? So I think yan, it has there is now this object view min var opt1. Let's take a look at this. All right. So you can see now you have it now includes these weights. Okay? Andun yung andun yung optimal values, data summary. So this is now the result class. Ang suggestion ni R that the weights should be 32% Apple and 67% Google. Ano yung objective measures natin? Standard deviation. Okay, the measure for the standard deviation is 1.6% for your portfolio. Okay? Optimal values. Okay, pareho lang siya ng standard deviation. This is the formula, port min var random. This is our portfolio. Okay, ito yung assets natin, constraints, objectives. Right, and it took us 1.05 minutes to run the portfolio. Okay, so you can see here that the portfolio that will generate the least amount of risk is 32% Apple, and then 67% will be your oh, sorry, it's already time, class, sorry. 67% will be your Google. All right, so I'll just okay, I'll just run this. I'll just give this to you. How to extract the optimal weights. It's just the same, class. Okay, there. So to conclude, class, to extract the optimal weights, you have this object, right? Mean var, optimal one, and then you just get the weights. So this gives us 32% Google and 67%, 32% Apple and Google. And then same here, same metric here. Okay, objective measures is your standard deviation, 1.61%. So you will not find any other any other portfolio that gives us a lesser amount of risk. Okay. Now I'd like you to experiment this time. Create 4B. This time for 4B, it's this time return maximization, and try to see what's the difference between step 4B and then step 5B, extract the optimal weights. All right, so I'd like you to look for that. So I'll just create a video on this, on the remaining parts of this. The others here makes use of the efficient frontier. Okay, so just a few more code chunks here. And then on Sunday, as I mentioned, I'll be discussing machine learning. All right, let me stop recording.